let's say gold goes up to the old normal 8-fold high, which is what, 8,000 plus in price. It would be where it was in 2011, where it was in 1980 in terms of dimension of move. Okay, do 3.5% of 8,000. Okay, well in the couple hundreds. Okay, yeah. So the point is that major lids are coming off here, not merely price chart stuff.
That's $280.
Yeah. Oh, or what if it goes to, it was up there at 6+ twice last weekend. Actually, you broke out in November. November's close. Gold relative to the S&P 500. Back in 2011, gold was, nice high levels in price and also outperforming the S&P. And then it started to collapse big time in 2013. That's when gold really started to come apart. And it kept going down through 2015. We're not looking at a price chart now. We're looking at price versus price, top chart. We divide an ounce of gold into the S&P 500 price, express the answer as a percent. And you can see in 2015, that first major drop halted just above 50%. Meaning an ounce of gold was about 50% the price of silver, of S&P, excuse me. And he had a bounce, and he came down again in 2018, made a low near 40%, and had another big bounce, outperformance of gold. That was that 2020 rally. Remember that the gold shot up about 40%, silver doubled in that time. So gold outperformed the S&P, but still it didn't have a structure, if you know what I mean. You'll see in a second what the structure is, the green line. Came down again in 2021, built a base for a couple of years, and it broke out of that base in early this year. You broke up out of that couple of years of horizontal action that peaked at around 48%. You'll see multiple peaks there. And you exploded. Where did you go? You came up to the green line. This is in April of this year. That's when gold was 3,500. The spread reached almost 60%. And they hit it again, which tells us our green line is a good line. It's very valid because the market responded to it again. November closed over it. So that says you've got an 11-year wide basing range of gold relative to the S&P where it does better, does worse, does better, does worse, but basically sideways for 11 years, either side of, let's say, 50%. You just broke out. Now, if this were a price chart and I dropped it on your table in front of you and wiped out the title so you didn't know what it was, it said, look at this chart. You'd say, gee, I got to buy that beast, right? Okay, fresh breakout. Well, this is a fresh relative performance asset class shift saying, yeah, gold's been doing better than the S&P for the last year, but it's really going to do better now. You just cleared a major base. And then when we go to the strongest index in the S&P over the last decade especially, it's Nasdaq 100. And even versus it, and these readings are as of last, they're not up to date. It's a little higher now. Broke out also. And when we go to the Dow, which is in this, the Dow 30 or it's not in this anyway, the Nasdaq, the New York Composite, it broke out months ago. Gold broke out versus them. So versus any stock index you want to throw up there and say, should I own the stock market or gold? None of them are beating gold now. They've all just been broken out above. And it's a start of something big. You don't break out of something like this and go up for a month or two and fail. This is just the beginning.
What does this imply for the rest of the market? What does this imply for the economy? What does this mean?
The economy is going to weaken probably with the stock market. It almost always does. We think the stock market is in a topping process. It has been since early this year. By that, I mean price hit a level at, S&P got the 6150 area, I think it was, early in January. Collapsed down to April low, then came back up through the January high and has reached up to the 6,900 level. So about 10 or 12% beyond the early high. But I think it's still part of a laboring process, a topping process, which is very similar to the year plus wide action we had in 2000 when the market topped. In 2007, when the market topped and it came up, made a new high marginally, cheered everybody on. And then it took it a whole year or so of distribution for it finally to roll over and start the bear trend. It wasn't like the floor came out instantly. No, it was a laborious process. And already gold is saying, hey, it's really just begun. The gold strength versus S&P, or you can convert it the other way, S&P weakness versus gold. It's just begun. So we suspect at MSA that probably the stock market is still going to be laboring for another couple months, possibly with a marginally higher high than we've seen the last 3 months. For example, S&P saw 6,900 3 months ago, and then again this month. It might go up and hit 7,000 to ring a nice number in, make everybody happy, and take that out. I don't think it's going anywhere on the upside of any significance. So far, it hasn't for about 3.5 months, by the way. It's been mostly lateral. And probably sometime in the second quarter, you're going to see stock market weakness that people will call weakness, whether they're upset by it. But meantime, I think it's going to be a boring, languishing effort by the stock market to hold. But meanwhile, gold is soaring compared to it. So money is starting to shift. If somebody's buying gold over the S&P, otherwise that spread wouldn't have broken out. And it's certainly not the average American investor. We know that.
When gold's performance is measured against equities instead of in dollars, the message becomes clearer. After spending roughly 11 years trapped in a wide range, gold recently broke decisively above its long-term ceiling relative to the S&P 500. Technical markets treat such breakouts as powerful signals, especially when they emerge from decade-long bases. This is not a brief surge. It resembles the early phase of a major trend. Gold is now outperforming every major U.S. equity index, including the Nasdaq 100, suggesting capital is quietly rotating away from stocks and toward hard assets.
Each of those first moves, the 76 bear low, which was a correction from $200 down near 100, summer of 76, you went from that low near 100 to 850 in that first move. 8-fold move. 8 times the bear market low. Okay. Then you made a low in 2001 in price, and you multiply that times about 8, and what you got? The 2011 high. Another 8-fold move. No, on an arithmetic scale, it would be far more dramatic, but on a ratio, logarithmic scale, which how much did gold go up in multiples? 2 moves of 8-fold dimension. If you measure from the bear low in 2015, which is $1,050, it says, well up in the 8,000s. And then finally, you'll have only matched what you did twice before. Hardly a headline. I've done it before twice. It's probably going to go way beyond there. But people who think that gold is overdone, right now we're only 4-fold. So it doesn't compare to the dimensionality of the price changes 76 to 80, 2001, 2011. We're only halfway there. So that's something to pause and think about. Yeah, on an arithmetic scale, you look at the action the last 6 months or so, you say, I got to take profits. Yeah, right. Okay, fine. Do it if you want to. But meanwhile, gold just broke out above the biggest stock market in the world. It says, I've just now begun to beat you. Just begun. Well, okay. Anyway, then the real issue for us right now is not gold. Everything there is positive. It's been positive for us since 2016, but it's silver. And this is the same 50-year period of time. Ratio scale again. And you can see that the low end of that rectangle is like about $4 back in 1993 and also in the mid 70s. And you shot up there in 1980 to $50, okay? So it's a little bit better move than that first gold move. Gold went up 8-fold, silver went up about 10-fold during that multi-year move, with a lot of it compressed in the last 6 months of that move, where you really exploded. Okay. Then you went sideways for decades. And then in 2011, again, with a spurt in the last 6-7 months of that move, that's the second ellipse there. Then you went up to 50 again. Okay. And meanwhile, gold's blasted way above that first high, right? Okay. Yep. 8-fold. Silver's the same fold over and over. Okay. Then you come back down again in silver, mid-range this time, based. And now you've punched through. That last reading is $62. We're now trading at about 65. This is as of a week ago. But you finally punched out of that range a bit. Now, that's a price chart. We look primarily at momentum, and momentum has already said you're going to leave the earth here. Okay. Price now sort of says, oh, me too. Okay. But if you take the dimensionality of those first two swings, which were redundant in the case of silver, and swing it up and say, okay, I'm going to match the logarithmic scale dimension of that rectangle. This is $500. This is log scale, remember. So 500 would be about where that arrow top is, that third arrow, the second arrow there. That'd be about $500. Now, that's crazy, right? Yeah, okay, well, maybe it is. Okay. Silver, how come silver didn't do what gold did for 50 years? It moved with gold, but it didn't move in the dimensionality that gold moved. One reality, a new reality, now a third reality. Silver's just broken out of the very first reality. Well, there's arguments for that, why it occurred,
Historically, sustained gold outperformance tends to coincide with economic stress or late cycle conditions. Equity markets often peak through long, exhausting topping processes rather than sudden crashes. That pattern appears to be repeating. Stock indices have pushed to marginal new highs but lack momentum, trading sideways for months. Meanwhile, gold continues to strengthen beneath the surface. This divergence suggests institutional money is repositioning defensively. If history is a guide, equity weakness may emerge gradually, while gold benefits from uncertainty, tighter financial conditions, and declining confidence in traditional growth assets.
There's something that happened back then in that first ellipse and the second ellipse. There's just price charts here. It wasn't the momentum of price that said something, because already at that point in time, you were well into a bull trend, as you can see. They were already going up nicely before you got into that sharp ellipse period there. When we measure silver, ounce of silver divided into an ounce of gold, we create a spread chart. A lot of people look at ratio. We do it another way. We ounce of silver into an ounce of gold. And at those points in time, prior to those 6 or so months of verticality, the spread chart of silver versus gold broke out over a nice clear ceiling. So if you were only looking at silver versus gold and plotting it as a percent, you would have seen, you could have plotted a chart where there was a ceiling. You broke out, and when you broke out on the spread, that's when silver said, okay, I'm unleashed, versus gold and versus net price. We broke out of that same spread that gold broke out above the S&P in November. Silver broke out versus gold at the close of November. Where was silver then? I think it was the mid-50s, okay? Already, since the close of November, we're in the month 1 of the countdown now. Let's assume we got like 6 months either way, 5, 6, 7 months to do a surge like we did in 79 or late 2010, early 2011. Extreme compression, squished into a couple quarters where you go ape, okay? The spread told us back then at both those times. It's now telling us now, you just, not only are you breaking out above this range, which means getting above 50, but the spread broke out over a massive horizontal structure. So we have a silver gold breakout saying, no, don't buy gold, buy silver. It's going to catch up. Well, again, if I do a ratio of this, we're talking a crazy number, right? Maybe it's not.
Despite its recent surge, gold is not historically overextended. Past bull markets saw gold rise roughly 8-fold from major lows, both in the late 1970s and again from 2001 to 2011. By comparison, the current move has only achieved about half that magnitude. On a long-term logarithmic scale, this suggests gold may still be in the middle, not the end, of a secular advance. Short-term pullbacks are natural, but structurally, gold appears to be repeating a familiar pattern of powerful multi-year expansions following long consolidation phases.
There was also, that goes back to 2000 high. Actually, by our measurements, we're out above those peaks there. Okay. No, excuse me. No, there was a second shelf down below there. You'll notice. See the red circle, the first ellipse you've got?
Yep.
In between, there was this other range at about 1.31%. Yeah, right there. You broke out above that, and right now you're about to break out over the next level.
This one, yeah.
In which case, look at the normality going back to 70s. I mean, you went up to 6.5-fold a couple times, 6.5% of the price of gold. And then in 2011, you went up to 3.5% of the price of gold. We're trading above 1.5. Imagine if this breakout just takes you up to the lesser high at 3.5.
Mm-hmm.
That's the ratio, not the ratio, the spread difference in silver gold in the 2011 surge. Well, given that silver's already broken out of a 50-year range, why shouldn't the spread maybe do the same? Oh, whoa. We're talking 7%? Mm-hmm. Okay, forget that. Let's just focus on the 2011 peak. That was, again, a bull market peak. The spread also made a high at 3.5, well above all the highs of the prior decade or two. What if we just go to 3.5? Well, that means you could basically double and a half the price of silver relative to gold from here to there. So if gold goes up, let's say gold goes up to the old normal 8-fold high,
mm-hmm.
which is what, 8,000 plus in price. It would be where it was in 2011, where it was in 1980 in terms of dimension of move. Okay, do 3.5% of 8,000. Okay, well in the couple hundreds. Okay, yeah. So the point is that major lids are coming off here, not merely price chart stuff.
That's $280.
Yeah. Oh, or what if it goes to, it was up there at 6+ twice. What if you could do that?
Silver, long overshadowed by gold, may now be entering its most explosive phase. Historically, silver lags early in precious metal bull markets, then accelerates violently near the midpoint. After spending decades trapped in a narrow range, silver has recently broken above critical resistance levels. Momentum indicators turned positive before price followed, a classic early warning. Unlike gold, silver faces persistent supply deficits, with industrial demand outpacing production. Because most silver is mined as a byproduct, supply cannot quickly respond to higher prices, creating conditions for rapid upside moves.
These sound lunatic, okay? There's one chart I want to show you that shows these events happen. They're rare, but they're not exclusive to special markets. And that's the copper and lead charts. There you go. We put out this report in late October. At that point, silver, by the way, was $48, just to make a note. We were trying to show our subscribers, this is a history of the price chart of copper. And below, we'll look at lead in a second. But see that first low rectangle there? Mm-hmm. Actually, you could go further back. Instead of the 90s, you go back into the 70s and see the same range existed up and through mid-2005. So many decades of up, down, normal reality for copper. The red ellipse took place over a span of a couple quarters. You quadrupled the price of copper between there and about 2007, very quickly. And then look at the new range that existed since 2008. Yeah, there was a sharp drop after that. But look, the average range up there is like $8,000 per, I guess, per metric ton. But about 4 times the average range that existed back in the 70s, 80s, 90s, 2000. So copper broke out into a new reality, and it didn't take it 3 years to get there. It took it a couple quarters. There was no headline. Okay, scroll down, now you see lead, another exciting metal. Okay, same range-bound situation, going all the way back to the 70s. Its breakout occurred in 2006-07. Not the same time as the copper move. It wasn't a base metal explosion. Lead was firming up, but it didn't really go ape until that red ellipse. Okay? You went from an average price in that range in the 70s through 2007 of about, let's call it about $600, the average price. And you went up to 3,600, and most of that occurring in about 6-7 months. Again, not in sync with copper. It's its own thing. And then it dropped, but then look what happened after that. You went into a new reality. Multiple times more than the average reality. How come silver's in the old reality? We know we have a supply-demand problem with silver, 5 years in a row, consuming more than we got. And there's not much capacity to really increase production because most production does not come from silver mines. comes as a secondary product of the base metal mining, which means you can take the ounce of silver up sharply, but it's not necessarily going to impact the guys who manage a copper mine because it's too marginal in their overall production. To increase production just to get some more silver, you get the point. So it's a very unique position. Plus, we got a bull market in gold, and silver moves. It's a monetary metal, and it's undervalued, and therefore it could go ape. It's happened before, not just copper, lead. I could have thrown darts at half a dozen other markets, bread prices or something.
The most compelling signal comes from the silver to gold relationship. In prior bull markets, silver surged only after breaking out against gold itself. That same breakout has now occurred again. Historically, such moments preceded short but dramatic advances compressed into a few quarters. Comparable behavior has been observed in other commodities like copper and lead, where decades-long ranges gave way to sudden price re-ratings. These events are rare, but real. The data suggests silver may be entering a new pricing reality, one defined not by speculation, but by structural scarcity and capital rotation.